Salutations, everybody. For those who don't know who I am, my name is Timothy Lee Rogers Sr., and I'd like to welcome you to Learn to Trade Futures with yours truly, Lil Timmy Rogers. Yo. What's going on, everybody? Again, I'd like to welcome y'all to another episode of Learning to Trade Futures with yours truly, Lil Timmy Rogers. This is episode 6. This is episode 6. This is a very special live episode of Learn to Trade Futures with Lil Timmy Rogers. So for those on the replay, go here and look at the episodes 1, 2, 3, 4, and 5, and then come back here. But for those that's live, there's nothing there to click because we're live. I apologize for my tardiness. I don't even have my slides up. Y'all bear with me while I get my slides up. But we're going to get into it. This one ain't going to be as polished as the recorded versions because y'all know how I do. Y'all know I get off on tangents. Y'all know I get off on tangents, but I'm gonna try to stick to the script. Just bear with me while I get my slides together, get everything on the proper screen. That is the proper screen. Yes, it is. That is the proper screen. So let me do this. Let me share. Since I'm doing it live, I need to put it on that screen. Okay. Y'all forgive me once because I'm doing it live, so I need to put it on the screen where I'm going to be looking. Okay. There you go. Now, got that on the screen where I'm going to be looking. Did I leave y'all on the other screen too? I left y'all on the other screen too. So I need to bring y'all over here with me. Yes. Now, I think I might be. Hold on. What's going on here? I'm sorry, y'all. Okay. There it is. All right. Now, I think I might be cooking with Crisco now. Yes, I'm cooking with Crisco now. There we go. All right. Now, since we are live, let me go ahead and shout out everybody that's in the chat since we are live. Right? What's up, the Father of Legends? Salute. Ahmed. Is that Ahmed from Ahmed? That's what was the company with the resume thing? Oh no, that's Ahmed. That's Ahmed. This is Ahmed. That's somebody different. Okay, that was Ahmed. Like that's how he taught me to say his name. And when you play tag, Ahmed. But this is Ahmed. That's somebody. What's up, Ahmed? I appreciate that. Michelle Tucker. What's going on? What's up, Charles? What's up, Ahmed? What's up, Michelle Tucker? What's up, Erica? E-Rock, I see you got the notification gang. What's up, Deborah? Brother is the coach, needs a class, counters or week. What brother is the Koch? What's Koch? Change of character? What's Koch? I don't know what Koch is. I don't know what the term means. Needs a close or candle wick. Y'all distracting me. We in class, right? See how I go? See how I go? I get distracted. We in class. Save the questions to the end. We're gonna talk about questions at the end. Let's get into it, man. Now that I got all that out the way, hello. Let me welcome you to episode 6 of Learning to Trade Futures with yours truly, Lil Timmy Rogers. If you will, direct your attention right over here. And we're going to get into, Michelle, I just said stop asking questions. I'm just playing. I think he's asking about breaker, change of character. Yeah, I heard people talk about changing character, but I don't know what that means. I'll put, if y'all don't mind, I'm gonna put the mic up close. I like for the mic to be close to me. Hopefully I don't be too loud when the mic be close to me, but when the mic be far away over there, I be feeling the need to lean down, but I'm gonna pull the mic up close to me. I don't know what change of character is, but like I say, stick around to the end and we can talk about whatever questions y'all want to talk about. But let's get into the class for the people that's only here for the Learning to Trade Future series and not all the babble I be doing on live. A jollipods for those who don't like my babbling. That's for you, Rocky. That's for you. Let's get into it, man. Learning to Trade Futures, Part-6. Part-6, the special live edition. Today, we're going to be discussing something that I feel is very, 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 very important when it comes to trading futures. Again, we've been talking about this in almost every episode. It's all about where is price trying to go. When it sums up, understand the order flow, understand how price move, understand where price is going. And let me pop off to just me for a second. Yes, I am using slides taken straight from Michael Huddleston's content again, because those are the concepts I trade. That's the language I understand when it comes to trading. And he put it out there for free. So I'm using his free tools to share with other people for free. If you don't trade ICT concepts, no harm, no foul. You don't have to trade ICT concepts to learn to trade futures. This is just what I do. This is what I understand. And it what works best for me. Thank you. Now back to class. We're going to talk about, some people call it the power of three. Some people call it accumulation, manipulation, and distribution. I call it both sometimes. Now, what is the power of three? Like I said, it's accumulation, manipulation, and distribution. 1, 2, 3. You have 3 different stages or phases, whatever you want to call it, that price will move in. This can be applied to all time frames. It can, all aspects of trading. It can go from a candle to a session to a well, it can go from a candle to an hour to a session to a day to a week to a month. It, all time frames. All of the concepts of ICT can be applied to all time frames because it's price is fractal. Price is price. So why is the power of three so important? Because the power of three, just like the market maker models, it's another concept that lets you predict with a high degree of accuracy where price is trying to go. What is price most likely to do? It gives you a foundation to say, okay, this is what I'm predicting price to do, and give you opportunity to look for trades with the least amount of risk possible if you're disciplined. If you're disciplined. Okay, so let's get into it. The power of three, right? So we're going to talk about the importance of developing anticipatory skills. Y'all know how I always be talking about, we've come to an anticipatory reactionary point. Because you want to develop your anticipatory skills. What's up, Kareem? You want to be able to anticipate when price is going to do a certain thing. You want to be able to anticipate when price is most likely to move in a certain direction. Anticipatory skills, engineering liquidity in the market. Y'all know y'all heard us talk about engineering liquidity all the time. When do we say price is engineering liquidity? What does it be doing when we say price is engineering liquidity? It be consolidating. So in consolidation, is that the accumulation? I don't know. Let's go and see, right? Neutralizing liquidity in the market. Neutralizing liquidity. Oh, why y'all ain't tell me I ain't have my fancy dancy on? Let me turn on my fancy dancy. My fancy dancy is not. Y'all hold on, man. I turned my computer off, so now I got to get my fancy dancy together. Y'all hold on, man. I got to get my fancy dance together because my computer had turned off. So now I got to go turn my, there you go. All right, now my fancy dance is on. Okay. So where we was at? Oh, neutralizing. We were neutralizing the liquidity. Oh yeah, neutralizing the liquidity in the market, market making and pairing of orders, right? Market making and pairing of orders. Then we're going to talk about what accumulation looks like in the bull and bear market. We're just going to flip it over. We're going to talk about one, and you just got to flip it because it look the same, right? What manipulation, where manipulation occurs in the market, flip it over, and where this what distribution looks like in the market. Now, in the edited, polished versions, all of this stuttering and all that, that's what I be cutting out. I be cutting, like when I be saying right too much, I be cutting all that out. If y'all go back and look at the polished version of these videos, it's real smooth and seamless. It ain't no stuttering, no all that ain't no, I mean, ain't no right, none of that. Okay, moving right along, shall we? So when it comes to the power of three, these right here, let me go back real quick. All right. So for those that don't know, this right here is a bar. You have bar charts and you have candle charts. All right. This is a bar. All right. This is a bar. The open price on a bar is to the left. The close price on the bar is to the right. So just like on candles, the open and the close, the open on the green candle is at the bottom, the close is at the top, and the open of a red candle is at the top, the close is at the bottom. The bar chart, open is on the left, close is on the right. All right, so this is the same as this. This is a green bar or an up close bar. This is a green candle or an up close candle. So a down close bar with the bar would be to the bar to the right would be at the bottom, and the bar to the left would be at the top, and a down close candle would be red or whatever color you color your down close candles. So that's a bar, right? Through the thing, he uses bars in these slides. I prefer candles. I understand candles. It's easier for me to see candles. Like the bars, I get confused on, hey, what side is that tick on? Or is that the open and close? I understand colors, right? Like I'm a visual person. That color pops out to me. Now, let's move on. The opening range, right? I mean, the opening price. I'm sorry. The opening price for the power of three, the opening price is very important. Why is it very important? This is the initial value price prior to some type of imbalance. If y'all remember before when we was talking about institutional sponsorship, you see how all this stuff tying together? Institutional sponsorship, market maker buy models, market maker sell models, the power of three, all of this stuff, it gels together. It gels together. So if you understand what's happening, right? This is the why behind all the understanding what price is doing is, that's why I say that's the most important thing. That's what Michael taught us in the very beginning of understanding where price is trying to go. It's not about, hey, which PD array should I use? It's not about what's your entry technique. It's not about give me the perfect setup. It's understanding what price is going to do. And if you notice, everything from institutional sponsorship, price delivery, everything we've been talking about thus far, I can't remember everything we talked about. We on episode 6, but everything we've been talking about so far has been talking about what is price trying to do, and it's all just meshing together. Go back and check it out if you don't believe me. It's all been meshing together. So it's the initial price prior to an imbalance. What creates this imbalance? right? That institutional sponsorship, when it pushes price, get out the way, Mike. It pushes price like in one direction. It creates an imbalance to the buy side or the sell side. It just the what we call the pang out. It moves it one-sided, right? It moves it one-sided. So that opening price, that's the initial value price prior to that imbalance. So you want to keep that in mind. And this can be on a candle. This can be on a day. This can be on a session. This can be on a week. It's the opening price. Remember back when we talked about the most important thing you need to understand is open, high, low, and close. See how this all meshing together? Can you see it? Can you see it now? See how it's all meshing together? So the opening price. Then you have the closing price. That's the value after the imbalance, right? That's the value after imbalance. That's after, you know what I'm saying, we've gotten the imbalance, right? You got an opening price, you got a one-sided move, then you got a closing price. This can be on a candle. This can be on a day. This can be on a session. This can be on a week. This can be, you follow me? Y'all follow me? In between that opening price and that closing price, that's the expansion. That's the range expansion. Where have I heard that before? Where have I heard expansion before? Remember when price will consolidate? Then you have expansion and you have retracement. You have reversal. You have delivery. Wait, what do you mean? Is it all really coming together? Is it all really coming together? This is all the stuff that get cut out of the edited versions. I really be doing stuff like this. And I cut it all out the edited version because I be like, people don't want people. This is the live, Tim. People come to the edited version just to see a polished class. Whether they edit it today is live. So suck it up. Right? So that's the area between the body of the candle, if you will. That's the dynamic price range. That's the expansion. Okay? Y'all follow me? Now, manipulation. Just want to break down, you know what I'm saying, the areas of it right now. So now you got accumulation, manipulation, distribution. Right? Let's talk about engineering liquidity in the market. This is one form of manipulation here. So if it's a bullish expected delivery, you're going to be engineering liquidity through shorts. How are you going to engineer liquidity through shorts? Right? I want the unedited version. How are you going to engineer liquidity through shorts? You engineer the short liquidity because of people who got the bias of going short. They may be ultra bearish. They may see something to the downside they want to see. They may just be panicking when price opens up and takes off to the downside, right? So they're going to be going short when it takes off to the downside. And then there's going to be stops down there that's getting hit when price takes off to the downside. So the algorithm is manipulating the system by going down there and activating those shorts, right? They're activating those shorts to pump liquidity into the market. Why are they doing this? Why they are doing this? Because they are building long positions in what they call accumulation. So during this accumulation, right, and for the reverse, if they want to go short, during this accumulation, they're either building, the smart money is accumulating long positions if it's a bullish market, and they're accumulating short position if it's a bearish market. You just flip everything over. I ain't gonna be flipping no more. So every time I say accumulating long positions, automatically in your mind say do the same thing when they want to go short. So they're accumulating long positions during the consolidation. This is going to happen at or near the opening price. They're going to be accumulating these positions at or near the opening price. Why? Because this is the initial this is the initial agreed upon price when the market opens. The buyers and the sellers, they shake hands gentlemanly or womanly, whatever gender you want, or non-binary, whatever you want your market to be. They're shaking hands. Thank you. Thank you. They agree in there. So they start accumulating their positions. Now that the conditions are accumulated, right? They manipulate the market. In this case, they're going short. They're going short. I just noticed I got this slide twice. Boom. They're going short. Why they going short? Because they think the market is going short. When I say they, I'm talking about the uninformed money. Why? Because the market took a deep dive down, but the algorithm is going down there. They're going below price, right? They're catching breakout traders. What are breakout traders? Breakout traders are the people who, when they see a level of support or resistance and we break through it, they buy or they sell there. So in this case, it's breaking through a level of support, so they selling. The smart money is buying from willing sellers. According to premium and discounts, oh, look at how everything tied together so beautifully. Where do we buy? We buy in a discount. We don't sell in a discount. But smart money is, in this case, is buying. They're buying from willing sellers. Somebody is selling willingly. How are they selling? Through a sell stop from a position where they were already long and they had a stop placed below some type of support, or they're waiting below that support to play the breakout, and they're selling in a discount because they're not in sync with the algorithm and they don't understand we're in a discount. We're in an oversold condition. Their RSI is not telling them they're oversold, so they don't realize we're in an oversold condition, so they're trying to buy because they don't realize that it's an oversold condition. Now, once they do that, once the algorithm buys from willing sellers, like I said, there's not just breakout artists down there. There's sell stops down there. They are neutralizing and scaring anybody that was in a long position and they had a good entry. This has happened to me many a times because of poor stop placement. I may get into a trade with a fixed amount stop, and there's nothing wrong with that. I got a fixed amount stop, and the market goes against me, takes me out, and then continues in the direction that I thought it was going to go. That's when I adapted the strategy of proper stop placement. And with proper stop placement with futures, it will require you sometime to shift, either trading less contracts or shifting from the ES to the MES so that you can properly place your stop. Because with Forex and stuff like that, you can just reduce the size by saying, okay, I want to risk 1%, or I want to risk 0.5%. Wherever I put this stop, it's going to do the math to only risk the amount that you want. With futures, you buying contracts, so you got to do that math on your own. You got to say, okay, I'm only risking 1%. So if I put my stop down here, if I'm trading the ES, this how much it's going to be. If I'm trading the MES, this how. So you got to do the math on your own when it comes to, as far as I know, with the platform I use. I don't know how it works. If you do it in TradingView, maybe TradingView can do it for you, but I don't trade through TradingView. But I do know when I'm practicing TradingView, when I'm sliding it around, I just tell it the percentage that I want, and it'll calculate the percentage right. I don't know if it'll do that in live account. Go practice it on your own, but you want to understand proper stop placement, where you're putting the stop in a place where if you don't anticipate it to come below this low, you want to have your stop below that low and not have a fixed stop somewhere here in the middle, and it comes and stops you out, then goes in your direction. So don't be the one that's getting neutralized. Don't get neutralized and scared out of your long position or your short position fit. So the manipulation is twofold. You're catching breakout traders, engineering them shorts, and then you neutralizing and scaring the people that was in good long positions. Because once you get stopped out, I ain't gonna hold you. You be like, God dog it, I had it wrong. You scared to get back in. It shakes you out of your analysis. You scared to get back in, and as it's running, you start getting FOMO. And the farther it go up, the more you get FOMO, then you end up being the liquidity on the opposite end of the move. Right now, now, like I said, sell stops are being paired with buy interest. Who's the buy interest? It's the smart money, right? You're buying from willing sellers. Down there, you're buying from willing sellers. That's we already spoke about that. Sell stops are being paired with buy interest. Now, distribution is no more than just offsetting or pairing your long exit with pending buy interest, right? What do? We buy in a discount, sell in a premium. So when the smart money buys in a discount by pairing their long interest with willing sellers, at the top, they're selling to willing buyers, people who's willing to buy in a premium. And the same is the exact reverse. Like it's people up here that see this area as an area of resistance, and when we break through it, they are buying. They are willing buyers. And then what you say, trading view. In trading view, you can create order, and these are fields that set stop using dollar amounts. Okay, that's what's up. That's what's up. So trading view, you can do it. You can't do it with trading view with the futures. With Ninja Trader, you can't do that. So now I ain't switching my broker. If trading view ever pair with Ninja Trader and let me use trading view, then I will, but I ain't trading my broker just to trade on trading view. So you can do it on trading view. Proper stop management. You can say, hey, I only want to risk this amount of percentage. Appreciate that, Father Legends. I only want to risk this amount of percentage on this trade, and then it'll let you slide your stop to the proper stop placement, and it'll only risk that amount of the trade. That's coming from Father Legends there. Go out and test that and see if it works. Here we go. So again, and then you also have buy stops up there. So you got people that's willing to just get long on this breakout, and then you got people who were short and their buy stops are resting up there, and boom. So you're activating shorts and you're getting out of your long positions. You're selling to people who's willing to buy in the top. Right? That's how the power of three works. Right? You got the accumulation, the manipulation, then it takes off with the payout, and then you got the distribution on the opposite end. Now, let's go into price and see what it looks like in price. Accumulation. What does accumulation look like? Like we said, it's the consolidation area. When we be talking about it's consolidating, we call it engineering liquidity. It's engineering liquidity. So that's why you never want to try to like guess when price is going to break out of this consolidation. You want price to give you a sign. All right, so right here, we're engineering the liquidity. We're accumulating. And in this case, we're accumulating longs. How do you know we're accumulating longs? Because you've done your analysis, and Picasso lives up here somewhere. Picasso, he's resting up here near these highs up here. You've done your analysis, and this is where Picasso lives. Y'all know who Picasso is. So this is what accumulation look like. Consolidation. It's moving like that. This blue line right there, that's your opening price. That's your opening price right there. So right around the opening price, you're accumulating. You're accumulating longs in this case. You will be accumulating shorts if it was going the other way. Now, the manipulation. This is the manipulation. It takes off to the downside. Boo! Over there with your accumulation, when people see this break, boo! They see that breakout. You got people who think Picasso lives down here. They don't understand this is where Picasso, this is Picasso's Airbnb down here. Picasso is at home right now. He's not at the Airbnb right now. So when it breaks out, they say, we're going to go catch Picasso slipping at the Airbnb. Picasso not there. So they got tricked in, manipulated in. All right. So we sitting up here and now when the market gives you a break, we ain't gonna get into all that, but you look for your break in market structure, because guess what? The smart money is doing. They're looking for consolidation, expansion, reversal, and then a retracement. See what I'm saying? That's what they're looking for, but we're not talking about all of that right now. But see how it connects together? We're talking about the power of three. See how the power of three went right back to that? Consolidation, expansion, reversal, retreat. We ain't talk about that, but see how you can use the concepts to trade in between all the different things, all the different, like liquidity delivering, whatever. I can't remember the name of it right now. The market maker buy model, market maker sell models, the power. See how you can use all the different concepts to find trades in between when you're building the bridge to the other side. It's coming to, it's starting to click. Hey, what was I saying? Oh, there it is. I remembered it. You see that? Now you did. Oh, it's starting to make sense now. Now, manipulation. This is what manipulation look like. We accumulate, then we manipulate, moving away from Picasso, moving away from the draw, right? And then distribution. Distribution, once we get up there to Picasso's house, right? Once we get up there, we start, like say, offsetting or selling to willing buyers, people who's willing to buy up here. And once you get up here, guess what it's doing? Guess what algorithm is doing when you get back up here? Especially if it's a key high, if it's an anticipatory reactionary point, the cycle starts again. It starts accumulating shorts up here and starts to accumulate shorts and starts to get ready to move back down. Start the manipulation cycle. Start it all back over again if it's a key reactionary point. Accumulate an anticipatory reactionary point. So, what's your homework? Your homework is to go back through price on the December contract, back from August up until present, and on each time frame. Let's just start with the weekly. Let's start with the weekly. You can go to the monthly. If just go as high as you started a monthly and see if you see the power of three at the monthly with accumulation, manipulation, and distribution. Right? Accumulation, manipulation, and distribution on the monthly. Accumulation, manipulation, distribution on the weekly. Accumulation, manipulation, distribution on the daily. Go through all the time frames and look for and then for extra credit, take it all the way down to your entry time frame. If you enter on a 15-minute, go down to the 4 hour, 1 hour, 15. If you do on 5 minute, go down from the monthly, weekly, daily, 4 hour, 1 hour, 15, 5 minute, whatever your entry time frame is. Look back from August until present. Look through the price, looking for the power of three, where you can identify the power of three. That's your homework until next week. And with that, we have come to the end of episode 6 of Learning to Trade Futures with Lil Timmy Rogers. That's the end. I'll stick around for anybody who got any questions, but for everybody else who just tapped in for the class, for the lesson, or whatever you want to call it, to the next one, man. I see y'all. I'm gone. Yeah. All right, man. What's up? Y'all got any questions? Somebody asked a question about something earlier. Somebody asked a question about something earlier. Can't remember what it was. There it is. Brother, is the change of character needs a close candle or the wick good enough? I don't know what you're talking about. What's change of credit? Change of character. You talk about a break in market structure? You talk about a break in what's change of character? You talk about breaking market structure? You're welcome. You're welcome. Carino and Deborah. I don't know what change of character. Do anybody know what change of character is? Is that person still in here? Is that person ain't in here no more? I ain't even gonna worry about it. Do anybody know what that is? Is that the same thing as a break in market structure? What's change of character? Okay, don't see nothing in the chat. I don't see anything. I think breaking my okay, yeah. That person, I ain't gonna worry about it no more because that person ain't saying nothing no more. Anything else from anybody? Anything relating to if you want the slides, it's a link, should be like the second link in the description where you can download the slides. You can download all slides for episodes from the intro up until now. So it should be 7 sets of slides in there. There should be 7 sets of slides in there. That ain't doing it. That ain't doing it. Slides. So 1, 2, 3, 4, 5, 6. It's 6 sets of slides. There's no slides for the intro video. I forgot. So here's all 6 sets of slides. If you want the slides, if you would like the slides, just click on that link right there. It says download slides. And for anybody who feel like they're at the point where they want to try their hand at passing a trading account, eval, combine, whatever you want to call it, what's the nearest time frame to identify 2 equal highs and lows? Wherever the equal highs and lows are, there's no right or wrong time frame. It just depends on what you're trading. It depends on what you're trading. Me personally, I go 2 time frames up or down. That's my method of choice. 2 time frames up or down. If I'm entering on the 5-minute, I'm looking at hourly highs and lows. If I'm entering on the 1-minute, I'm looking at 15-minute highs and lows. The higher the time frame you're looking at for liquidity, the longer you're able to hold a trade or stay into the trade. The lower time frame you're looking at liquidity, the shorter amount of time you're going to be able to stay in for the trade. So it's like that's my rule of thumb is 2 time frames away. If you want to try your hand at a trading combine, my affiliate link is right here in the description of all my videos. Right now, Apex is having a 90% off sale. So you can get I tell people to go for the 25,000 account. You ain't got to go for the 50, you ain't got to go for the 100, because no matter what account you trade, for every account you pass, when you get a PA account, the first 25,000 of that PA account is your money. So pass the smallest one. You only need to make $1,500. You know what I'm saying? Yeah, you can't leverage a lot. It might take you 8 or 9 days to pass it because you're not leveraging a lot. But passing is passing. You know what I'm saying? 25. Because once you pass it, you got to literally pass it again before you can start withdrawing. So why give yourself this big goal of making $3, $6, $9,000? Then you got to make, just say if you're going for 3,000, 50,000, you got to make $3,000 and not lose 2,500. So you got to make 3,000, pass it. You know what I'm saying? Pay for the assignment fee, then make 3,100 before you can start withdrawing money. But you got to make more than 3,100 to withdraw money the smart way, because the 3,100, that's going to be your, you know, your trailing stop going to stop right there at that 3,100. So you don't want to start eating into that trailing stop. You know what I'm saying? You want to, you know what I'm saying, get above that and have you a little cushion above that 3,100. So you got to really make at least 3,700 if you want to withdraw $500 the smart way. Because you make 3,700, then you take out 500, that leave you $100 a cushion on top of that 3,100 that you had to make. So you can draw out 500, and then you build it back up, draw out you another 500. You just keep, every time you make $700, you take out 500, and then you having an extra $200 each time. So your cushion getting bigger and bigger and bigger. Make 700, take out 500. You know what I'm saying? Make 700, take out 500. And you doing this over 10 days. You know what I'm saying? You making $700 over 10 days, and then you only take out 500, 10 trading days. You only take out 500, because you can take out twice a month if you time it right. If you trade every single day, right, you can take out twice a month. So you make 500, you make 700, take out 500, make 700, take out 5. So them them little 200s, they adding up in your cushion, getting bigger and bigger and bigger and bigger and bigger. You know what I'm saying? And then one day around Christmas, when you be like, but you only paying taxes on that 500 you taking out. And then you pulling out that 500, you only paying taxes on that 500. Right then, one day around Christmas, when that 2 been building up over the months, you know what I'm saying? Then you take out like a $3,000 withdrawal and go buy something nice for Christmas. For me, the 3,000, I'm reading the comments over there in live time. The 3 count was easier psychologically than the one. Exactly. That's what I'm saying, because you looking at this big lofty goal of like, man, I got to make all this money. Then I got to make all this money again. And then you hear about these people online talking, I just passed. And you feeling like, man, what am I doing wrong? Then you start over leveraging. Then you start spiraling. Then you be like, oh, look at me. I done messed up again. Hopefully I answered the question there, Carino, when it comes to like the equal high, it's whatever time frame it appear on, the equal high and equal low is going to be there. But when you're looking for like raids on liquidity, I personally utilize the 2 time frame technique. Does anybody have anything else before I call it? Does anybody have anything else before I call it? Again, this has been another episode of Learning to Trade Futures with Lil Timmy Rogers. Remember, do your homework. Remember, if you have not watched episodes 1, 2, 3, 4, 5, please do so. To the next one, man. Y'all be safe out here in these trading streets. Aranya Grande out.